There is a final promise that separates the amateur from the master, the gambler from the investor, the 99% from the 1%. It is not a promise of guaranteed riches or a secret formula for picking winning stocks. It's something far more profound, far more personal. It's a promise you make to yourself. It's a quiet vow of intellectual honesty, a commitment to a single brutal principle that, once adopted, will change the very architecture of your financial life. This principle is the bedrock of Warren Buffett's entire philosophy, the source code of his 70-year reign as the undisputed king of capital allocation. And it is deceptively simple. You do not have to be an expert on everything. In fact, your greatest power comes from admitting that you are not. It comes from drawing a small, clear circle around the things you truly understand, and then having the discipline, the sheer iron-willed fortitude, to never, ever step outside of it. This isn't just an investment strategy, it's a mental operating system for navigating a world saturated with noise, hype, and alluring opportunities designed to part you from your money. It is the machine that allows you to say no to 99% of the ideas that cross your desk, so you can say a resounding, confident yes to the 1% where you have a genuine, unassailable edge. Today, we are not just going to talk about this principle, we are going to build it, piece by piece, inside your own mind. We will deconstruct the psychological traps it helps you avoid, and we will assemble the practical blueprint you can use to forge your own circle of competence, starting tonight. This is the key to unlocking true financial freedom, not by chasing every trend, but by mastering your own small corner of the universe. This is the final promise. The story of Warren Buffett's most powerful idea doesn't begin in a bustling boardroom or on the chaotic floor of the New York Stock Exchange. It begins in the quiet, dusty stacks of a university library in Omaha, Nebraska. It begins with a young man, preternaturally gifted with numbers but still searching for a framework, a philosophy that could turn his raw talent into a coherent and repeatable process. He devoured books on business and finance, but it was one particular volume that struck him like a bolt of lightning, a book by his future mentor Benjamin Graham, called The Intelligent Investor. Within its pages, Graham laid out a worldview that was completely at odds with the frenetic energy of Wall Street. He didn't talk about predicting market swings or chasing hot tips. He talked about something much more grounded, much more controllable. He introduced two allegorical characters that would shape Buffett's thinking for the rest of his life: Mr. Market and the concept of a margin of safety. Mr. Market, as Graham described him, was your manic-depressive business partner. Every day, he would show up at your door and offer to either buy your shares in a business or sell you his at a specific price. Some days, he would be euphoric, offering you wildly optimistic prices. On other days, he would be despondent, offering to sell you his shares for a fraction of their true worth. The key, Graham argued, was that you were under no obligation to transact with him. You could ignore him completely. You only engaged when his mood swung to an extreme that was to your advantage. This simple parable contained a profound truth. The market is there to serve you, not to instruct you. You don't take your cues from its wild emotional swings. You take your cues from your own independent analysis of a business's value. But how do you determine that value? That's where the second concept, the margin of safety, came in. Graham's principle was to never pay the full estimated price for a business. You calculate what you believe a business is worth, its intrinsic value, and then you insist on buying it for significantly less. You buy a dollar bill, but only if you can get it for 50 cents. This gap, this margin of safety, was your protection against bad luck, errors in judgment, or the unpredictable vicissitudes of the economic world. It was the financial equivalent of building a bridge that can hold 30,000 pounds, but only ever driving a 10,000-pound truck across it. For the young Buffett, reading these words was an epiphany. He realized that the entire game of investing wasn't about being a brilliant oracle who could predict the future of technology, politics, or consumer tastes. It wasn't about having a stratospheric IQ that allowed you to master every industry. The game was about discipline, it was about temperament. It was about finding a business you could understand, calculating its value with a reasonable degree of confidence, and then waiting for the emotionally unstable Mr. Market to offer it to you at a stupidly cheap price. The entire system was predicated on one crucial, unstated assumption: that you had the ability to actually understand the business in the first place. If you couldn't value the business, you couldn't determine a margin of safety. If you couldn't determine a margin of safety, you were just gambling, hoping Mr. Market's future euphoria would bail you out. This intellectual awakening formed the genesis of what would become his circle of competence. He saw with perfect clarity that his task was not to widen his circle to encompass the entire universe of stocks. His task was to define the borders of his existing circle with brutal, unflinching honesty. He knew he could understand businesses like insurance, newspapers, and consumer products. He could read their financial statements and, with a high degree of certainty, project what their earnings would look like in 5 or 10 years. But complex electronics companies? Pharmaceutical research firms? He had no special insight, he had no edge. So he made a decision. He would simply ignore them. They would be relegated to his too-hard pile. While others on Wall Street were chasing the next big thing, Buffett was in Omaha, patiently studying the balance sheets of chewing gum companies and regional banks, operating within a self-imposed boundary of knowledge. This wasn't a sign of weakness or a lack of ambition, it was the ultimate expression of intellectual strength. It was the humble yet powerful recognition of his own limitations and the strategic decision to play only the games he knew he could win. This entire philosophy is a masterclass in overcoming a pervasive and dangerous flaw in human cognition known as the Dunning-Kruger effect. This psychological principle, identified by David Dunning and Justin Kruger in 1999, is a cognitive bias whereby people with low ability at a task overestimate their ability. It's the old cliché, a little bit of knowledge is a dangerous thing. An investor reads a handful of articles about artificial intelligence, learns a few buzzwords like neural network and large language model, and suddenly feels they are qualified to pick the next NVIDIA. They mistake familiarity with jargon for genuine competence. They are standing on the peak of what Dunning and Kruger called Mount Stupid, a place of high confidence and low expertise. Conversely, the researchers found that people with high ability tend to underestimate their relative competence. They are so acutely aware of the nuance and complexity of their field that they assume others must have a similar level of understanding. Warren Buffett's circle of competence is a deliberate, systematic defense mechanism against the Dunning-Kruger effect. It is a forced process of self-assessment. By demanding that you define the perimeter of your knowledge, it forces you to confront what you don't know. It makes you ask the hard questions. Do I really understand this business model? Can I explain, in simple terms, how this company makes money and why it will continue to do so for a decade? Could I hold my own in a debate with an industry expert about this company's competitive advantages? If the answer to any of these is a hesitant no, then you are likely on the slopes of Mount Stupid, and the circle of competence yanks you back down to the valley of humility. It protects you from your own unearned confidence. This is a critical component of risk management, more important than any complex financial model. It understands that the greatest risk in any portfolio isn't market volatility, it's the investor's own ignorance. By staying within a defined circle, you are ensuring that your confidence is earned, built on a solid foundation of deep knowledge, not the treacherous sands of surface-level familiarity. This self-awareness is the cornerstone of a successful trading psychology, allowing you to operate with calm conviction when others are panicking. So how can you, a retail investor or an entrepreneur looking to allocate capital, apply this powerful mental model? The first step is to perform what I call the 3 buckets audit. This is a practical exercise, a blueprint for defining the initial boundaries of your circle. Get out a piece of paper or open a new document and create 3 columns. The first column is Bucket 1, and you'll label it, I am an expert. This is your zone of genius. The contents of this bucket are derived from your professional life and your deepest passions. If you are a software engineer, you likely have a deep, intuitive understanding of enterprise software companies. You know the players, you understand the sales cycles, you know which products are legacy nightmares and which are game changers. If you are a doctor, you understand the healthcare system, the dynamics between insurers, hospitals, and pharmaceutical companies. If you are a marketing manager for a consumer packaged goods company, you understand branding, distribution channels, and retail dynamics. Don't just list your industry, be specific. List the subsectors, the business models, the competitive moats you understand at a granular level. This is the core of your circle. The second column is Bucket 2, I can become an expert. This bucket is for industries that are adjacent to your core expertise. They are areas where you have a foundational knowledge base to build upon. The software engineer might put semiconductor companies in this bucket. They don't design chips, but they understand their importance and can learn the difference between a GPU and a CPU. The doctor might put medical device companies in this bucket. They don't manufacture scalpels, but they use them every day and understand what makes one superior to another. This bucket requires honesty. It's not a list of things you find interesting. It's a list of areas where you are willing to do the hard work, reading 10K reports, studying industry journals, listening to earnings calls, to elevate them into Bucket 1. This is your growth zone, the area where you can strategically expand your circle over time through deliberate effort. The third and most important column is Bucket 3, the too hard pile. This is where you practice the art of saying, no, this bucket is for everything else. Biotech companies for the software engineer. Deep sea oil drilling for the doctor. For most of us, this bucket will contain 99% of the publicly traded companies in the world. And that is not a failure. It is a victory. It's a declaration of intellectual freedom. You are giving yourself permission to ignore the noise. When a friend gives you a hot tip on a revolutionary new cryptocurrency, you can smile, nod, and mentally place it in the too hard pile. When a TV pundit screams about a junior mining stock that's about to strike gold, you can change the channel, secure in the knowledge that it belongs in the too hard pile. This audit isn't a one-time event, it's a living document that you should revisit every year. It's your personal map to the market, showing you where to hunt and, more importantly, which dark forests to avoid. This is the first step toward crafting an investment strategy that is uniquely, powerfully yours. To truly appreciate the power of this approach, we must spend some time exploring its opposite. We must walk the path of the 99%, the path paved with good intentions and disastrous results. Meet Dave. Dave is a smart guy, an architect. He's successful in his field. In early 1999, Dave starts hearing about the internet. It's everywhere. His kids are using it, his clients are asking for websites. At a cocktail party, his friend, who works in tech, tells him about a company called pets.com. It's revolutionary, Dave. They're going to change how people buy pet food forever. They're selling dog food online. Dave doesn't own a pet. He has no idea about the logistics of shipping heavy bags of kibble or the razor-thin margins of the pet supply industry. But he feels a powerful sense of FOMO, the fear of missing out. He sees the stock price going up every day. He feels like he's being left behind, a relic of the old economy. So he takes a significant chunk of his savings, money he'd set aside for his kids, college, and he buys shares in pets.com. He also buys a few other .com darlings he read about in a magazine, Webvan, eToys, GeoCities. He doesn't read their financial statements because, frankly, they wouldn't make any sense to him. They have no earnings, just eyeballs and burn rates, but he feels sophisticated. He's part of the new paradigm. Contrast Dave's approach with Warren Buffett's during the same period. Buffett was being openly mocked. He was a dinosaur. He didn't get the new economy. At his annual shareholder meeting, someone asked him why he wasn't investing in technology. His answer was simple and profound. He said he had no way of knowing which of the hundreds of new internet companies would be the winner in 10 years. He couldn't look at their business models and project their future cash flows with any degree of certainty, so he did nothing. He stuck to what he knew: Coca-Cola, Gillette, American Express, businesses with long histories of profitability, powerful brands, and predictable earnings. He was following the first rule of his own circle: if you can't understand it, don't invest in it. We all know how this story ends. In November of 2000, just 268 days after its IPO, Pets.com went bankrupt. The stock was worthless. Webvan, eToys, and hundreds of others followed suit. The Nasdaq crashed by over 75%. Dave, the architect, was financially and emotionally devastated. He lost a huge portion of his life savings, not because he was stupid, but because he ventured into a game where he didn't know the rules. He was playing poker against professionals and had never even read a book on the game. He was the quintessential jack-of-all-trades, master-of-none investor. Buffett, on the other hand, saw Berkshire Hathaway's book value continue to climb. His discipline, his refusal to be lured by the siren song of the new and shiny, had preserved his investors' capital, leaving him with a mountain of cash to deploy when the dust settled. This is the stark reality. The path of the 99% is a path of chasing narratives, of outsourcing judgment, and of mistaking market hype for a genuine investment thesis. It is a path that almost inevitably leads to ruin. The financial connection here is direct, brutal, and mathematical. The most important, yet least understood, principle in long-term wealth creation is the avoidance of catastrophic loss. The math of losses is unforgiving. If you have a $100,000 portfolio and you suffer a 50% loss, you are left with $50,000. To get back to your starting point, you don't need a 50% gain. You need a 100% gain. A single large loss sets you back years, even decades. The circle of competence is the most powerful risk management tool ever devised because its primary function is to prevent you from making the kind of unforced errors that lead to these portfolio crippling losses. By refusing to invest in industries you don't understand, you are systematically eliminating the highest risk bets from your universe of possibilities. You are avoiding the biotech company whose fate rests on a single FDA trial you can't handicap. You are avoiding the tech startup with a high cash burn rate whose survival depends on future funding rounds you can't predict. You are protecting your capital from your own ignorance. This discipline has a direct impact on a key metric used by professional wealth management firms: the Sharpe ratio. The Sharpe ratio measures a portfolio's return relative to its risk. A higher Sharpe ratio is better. The average investor, like Dave, chases high returns without any regard for risk. They might have a great year followed by a catastrophic one, leading to a very low or even negative Sharpe ratio over time. The investor who operates within their circle of competence may have less spectacular home run years, but they also avoid the devastating strikeouts. Their returns are more consistent, their volatility is lower, and as a result, their risk-adjusted returns, their Sharpe ratio, are far superior. Over the long run, this consistency is what builds serious wealth. It's not about finding the one stock that goes up 1,000%. It's about not owning the one that goes to zero. The circle of competence is your shield. It ensures that the capital you work so hard to accumulate is preserved, allowing the slow, patient, and inexorable power of compounding to work its magic. This isn't a get-rich-quick scheme. It's the blueprint for a financial fortress. To truly cement this idea, we need to look at it not just as a theory, but as a practice tested in the crucible of real-world high-stakes decisions. We need to examine the moments where billions of dollars were on the line, and the outcome hinged entirely on the integrity of this single principle. Let's travel back to 1972. Warren Buffett and his partner, Charlie Munger, were presented with an opportunity to buy a company called See's Candies. On the surface, It didn't look like a typical Buffett investment. The asking price was $30 million, but the company only had about $8 million in tangible assets like buildings and equipment. This meant they would have to pay $22 million for something that wasn't physically there, an intangible asset called goodwill. For a classic value investor trained by Ben Graham to buy companies for less than their liquidation value, this was almost heresy. Many of Buffett's peers would have walked away instantly. But See's Candies was squarely within Buffett and Munger's circle of competence. They understood the business of consumer brands. They understood the psychology of the customer. They knew that when a man in California wanted to apologize to his wife, he didn't just buy any box of chocolates. He bought a box of See's. He didn't check the price. He associated the brand with quality and with making amends. This gave See's incredible pricing power. They could raise their prices by 10% every year to cover inflation and rising costs, and their customers wouldn't even blink. This brand loyalty, this mental real estate the company owned in the minds of its customers, was the real asset. Buffett and Munger realized that the $22 million in goodwill wasn't an overpayment, it was the entire point. They could project, with a high degree of confidence, that the demand for See's candy wasn't going to disappear. It was a simple, understandable, durable business. They paid the $25 million final price, and over the years, See's Candies has generated over $2 billion in profits for Berkshire Hathaway, all without requiring significant additional capital investment. It was a triumph of competence, the ability to see immense value where others saw only an accounting fiction. Now, let's contrast that masterpiece with what Buffett himself calls his greatest mistake, a cautionary tale that vividly illustrates the dangers of a misjudged circle. In 1993, Buffett purchased the Dexter Shoe Company for $433 million. On the surface, it looked like another See's Candies. Dexter was a well-known, American-made shoe brand with a solid reputation. It seemed like a durable business. Buffett thought he understood it. Shoes, like candy, were a simple consumer product. He believed Dexter had a competitive advantage that would last. But he made a fatal error. What he thought was a durable competitive advantage was actually a fragile one, and it was about to be obliterated. He failed to appreciate the immense tectonic shift that was happening in manufacturing. Low-cost foreign competitors were beginning to flood the market with shoes that were almost as good as Dexter's but available for a fraction of the price. Dexter's Made in America appeal and its loyal customer base were not enough to compete with the brutal economics of globalization. The company's competitive advantage evaporated almost overnight. The business that Buffett thought he was buying for a fair price turned out to be worthless. But the mistake was compounded by how he paid for it. Instead of using cash, he used Berkshire Hathaway stock. The $433 million in Berkshire stock he exchanged for Dexter Shoe would, as of today, be worth over $12 billion. It was a multi-billion-dollar error born from a single, critical failure. He thought he was inside his circle of competence, but he was not. He understood brands, but he did not fully grasp the complexities of global manufacturing supply chains and the cutthroat nature of the footwear industry. The Dexter Shoe fiasco serves as a permanent, painful reminder, even for the greatest investor in history, that the edges of your circle are a danger zone. Overconfidence is a siren's call, and even a small miscalculation of your own expertise can lead to catastrophic financial consequences. The psychological trap that ensnared Buffett in the Dexter deal, and that ensnares countless investors every day, is known as commitment and consistency bias. Our brains have a deep-seated desire to remain consistent with our past decisions and beliefs. Once we've made a choice, especially a public one, we feel an internal and external pressure to stick with it. When Buffett decided to buy Dexter, his brain immediately started to favor information that confirmed his decision. He likely focused on the brand's history and its loyal customer base, while subconsciously downplaying the warning signs of foreign competition. After the purchase, as the business began to decline, this bias would have made it even harder to admit the mistake. The mind wants to protect the ego. It whispers, "Just give it more time," or "This is just a temporary downturn," or "My initial analysis was right, the market is just wrong." This is closely related to another cognitive flaw, the endowment effect, first described by Richard Thaler. We humans tend to place a higher value on things simply because we own them. The moment Buffett owned Dexter Shoe, his psychological valuation of it likely increased. It was no longer just a company, it was his company. The circle of competence is a preemptive strike against both of these biases. The rigorous analysis required to confirm a company is within your circle happens to before you commit capital. It's a cooling-off period for the ego. By forcing you to prove to yourself that you possess a genuine analytical edge before you buy, it reduces the chance of making an initial decision based on emotion or a flawed premise. It acts as a filter, ensuring that by the time you do invest, your commitment is based on a robust, logical foundation, not a fleeting narrative. It makes you less likely to fall in love with a stock and more likely to view it as what it is, a fractional ownership of a business that must continuously justify its place in your portfolio. If the facts change, as they did with Dexter, a disciplined investor who is not blinded by commitment bias is able to recognize the new reality and sell, cutting their losses before they become catastrophic. So how can we translate this into a practical tool to avoid our own personal Dexter Shoe fiascos? The mental model to apply here is the 5 Whys test for competence. This technique was originally developed at Toyota as a method for getting to the root cause of a problem, but it is an incredibly effective tool for testing the depth of your own knowledge before an investment. Before you even consider buying a stock, you must be able to answer 5 progressively deeper why questions about the business, and you must be able to answer them without resorting to vague jargon or regurgitating a talking point from a CEO's letter. Let's take a hypothetical example, a software company called Analytica. First, why? Why should I invest in Analytica? The surface answer might be, because they are growing quickly and are a leader in the data analytics space. That's a story, not an analysis. That's the path of the 99%. Second, why? Why are they a leader? What is their specific competitive advantage? A better answer would be, because their proprietary algorithm allows companies to process data 50% faster than their nearest competitor, and they have high switching costs because all of a client's historical data is integrated into their platform. Now we're getting somewhere. Third, why? Why can't a competitor, like Google or Microsoft, replicate that algorithm and high switching costs? A competent answer would require genuine industry knowledge. Because their algorithm is protected by a series of deep patents, and their platform is designed to integrate with legacy industrial systems that larger tech companies tend to ignore. The cost for a large factory to rip out Analytica and retrain its staff would be millions of dollars, far exceeding the licensing fee. Fourth, why? Why will customers still be paying for this in 10 years? Won't technology change? A truly insightful answer would be, the underlying need, analyzing industrial data, is timeless. While the technology will evolve, Analytica's deep integration with their clients' core operations and their continuous R&D spending creates a feedback loop. They evolve with their customers. Their business isn't about the current algorithm, it's about being the trusted data partner for the industrial sector. Fifth, why? Why is the current management team the right one to navigate the next 10 years? A well-researched answer would be, the CEO is an engineer by training who founded the company and owns 20% of the stock. Her incentives are aligned with long-term shareholders. The Chief Technology Officer has been with the company for 15 years and is a recognized expert in industrial data science. They have a track record of smart capital allocation, avoiding acquisitions and focusing on organic growth. If you can't answer these 5 questions with this level of specific factual detail, you are outside your circle of competence. It's that simple. This test brutally exposes the difference between casual familiarity and true understanding. It forces you to move beyond the narrative and grapple with the underlying business reality. It is the final checkpoint before you commit your hard-earned capital. The antithesis of this deep, probing analysis is the story stock investor. This is the individual who is seduced by a grand vision, a charismatic leader, or a world-changing technology, without ever doing the rigorous work to validate the business model. Think of the excitement that surrounded a company like WeWork. The story was compelling. It was a, quote, community company, not a real estate company. It was led by a visionary founder. It was going to change the very nature of work. People poured billions of dollars into this story. But they failed to apply the 5 whys test. They failed to ask, why is this better than simply leasing office space? Why are the unit economics of this business sustainable? Why can't a competitor simply copy this model? The story was so powerful that it blinded investors to the glaring red flags in the financial statements. Massive losses, a questionable governance structure, and a valuation completely disconnected from reality. The same pattern repeats itself time and again. Theranos had a brilliant story about revolutionizing blood testing with a single drop of blood, led by a CEO who was hailed as the next Steve Jobs. Investors were captivated by the narrative. They fell in love with the story, but they lacked the technical competence to ask the hard questions about whether the technology actually worked. They were outside their circle. The result for these story stock investors is almost always the same: a brief period of euphoria as the narrative gains momentum, followed by a brutal collision with reality and a near-total loss of capital. The 5 whys test is the vaccine against this kind of narrative-based investing. It forces you to be a skeptic, a detective, an analyst. It grounds you in the cold, hard facts of the business, protecting you from the seductive but ultimately hollow allure of a good story. This disciplined approach is a core part of any successful long-term investing plan. This distinction between understanding a story and understanding a business manifests directly on the company's financial statements, specifically in the line item called goodwill. When a company acquires another for more than the fair market value of its identifiable assets, the difference is booked as goodwill. It represents the intangible value, the brand, the customer relationships, the patents. When Buffett bought See's Candies, he correctly identified that its goodwill, its brand, was a real, durable, and even growing asset. That goodwill has been a fountain of cash for Berkshire ever since. When he bought Dexter Shoe, he thought he was buying the same kind of durable goodwill. But that goodwill was fragile. As the business deteriorated, accounting rules required Berkshire to impair or write down the value of that goodwill on its balance sheet. A goodwill impairment is a formal admission by a company that they overpaid for an acquisition, that the intangible assets they purchased are not worth what they thought. It is a direct destruction of shareholder value. The story stock investor is, in essence, buying a company for its story, which is a form of unbooked goodwill. When the story turns out to be false, as it did with WeWork or Theranos, the value of that story evaporates, and the investor is left holding assets worth a fraction of what they paid. Operating within your circle of competence means you have the ability to critically assess the quality and durability of a company's goodwill, both on and off the balance sheet. It allows you to distinguish between the enduring brand power of a Coca-Cola and the fleeting narrative of a Pets.com. This skill, the ability to properly value the intangibles, is what separates the master capital allocator from the amateur and is the ultimate financial benefit of staying within your well-defined circle. Expanding the definition of competence beyond just industries is crucial. Your circle must also encompass a deep and honest understanding of your own temperament, your own emotional breaking points. This brings us to the story of Rick Guerin, the third, lesser-known partner in the early Buffett-Munger-Guerin trio. By all accounts, Guerin was brilliant, just as sharp as his more famous partners. He understood businesses and could spot value with the best of them. But he had a fatal flaw. He was impatient, and he liked to use leverage. He would borrow money to magnify his investment returns. For a while, this worked spectacularly well. As the market went up, his borrowed money supercharged his gains. Then came the brutal bear market of 1973-1974. The market crashed, and it crashed hard. Stock prices were plummeting, including the shares of Berkshire Hathaway and other companies the partnership owned. Rick Guerin, because he had borrowed money, started getting margin calls. His brokers were demanding more collateral, or they would be forced to sell his holdings at the worst possible time. He was in a bind. Forced to raise cash, he had no choice but to sell his Berkshire Hathaway shares. And who was there to buy them? His partner, Warren Buffett, who famously never uses margin loans for his investments. Buffett bought Guerin's shares for around $40 a share. Those same shares are today worth millions. Rick Guerin was right about the value of the businesses, but he was forced to sell at the bottom because he had stepped outside his circle of emotional and financial competence. He had constructed a portfolio that could not withstand the storm. Buffett's own circle of competence wasn't just about knowing candy and insurance. It was about knowing Warren Buffett. He knew he was temperamentally suited for long-term holding, not for frantic trading. He knew he had the emotional fortitude to watch his portfolio decline by 50% without panicking. And most importantly, he knew that using borrowed money would introduce a factor into his financial life that was outside of his control. A margin call can force the hand of the most rational investor, turning a temporary paper loss into a permanent, catastrophic real one. This story is a powerful lesson. Defining your circle isn't just an intellectual exercise about industries. It's an introspective journey to understand your own psychological makeup and financial limitations. Your investment strategy must fit your personality. If you are someone who loses sleep over market volatility, a highly concentrated portfolio of volatile stocks, no matter how well you understand the businesses, is an inappropriate strategy. You are setting yourself up to fail, to sell, at the moment of maximum panic. This idea aligns perfectly with the Nobel Prize-winning work of economist Herbert Simon and his concept of bounded rationality. The classical economic view was that humans are perfectly rational actors who can gather all available information and make the optimal choice. Simon argued that this is impossible. The real world is far too complex. We have limited time, limited information, and limited cognitive processing power. As a result, we operate within a state of bounded rationality. We don't optimize, we satisfy. We make decisions that are good enough based on simplified models of the world. The circle of competence is the most intelligent and practical application of bounded rationality ever conceived in finance. It is an explicit acknowledgement of our own cognitive limits. Instead of trying to be semi-rational about 10,000 different stocks, which is an impossible task, you make a strategic decision to focus your entire limited cognitive budget on a handful of companies in a small number of industries. Within this tiny, self-defined area, you can actually get close to achieving true, unbounded rationality. You can read every report, listen to every earnings call, study every competitor. You can gather enough information and spend enough time thinking to make a genuinely optimal decision. The circle of competence doesn't try to make you a genius. It's a system designed for a non-genius to get a genius-like result by concentrating their intellectual firepower on a tiny target. It is a framework for optimizing the performance of your own imperfect human brain in a world of overwhelming complexity. This is the CEO mindset applied to personal finance, focusing resources on the highest return activities and ruthlessly ignoring everything else. To make this practical, let's move beyond the three buckets and create a blueprint I call the personal P&L method. This is how you find the starting point for your circle, based on the life you are already living. Think of your own life as a small business. Start with your revenue. Where does your income come from? Your job, your career, your business. This is your number one area of deep expertise. If you're a logistics manager for a trucking company, you understand transportation costs, fuel prices, and supply chain dynamics better than 99.9% of Wall Street analysts. Your hunting ground should be publicly traded trucking companies, railroads, and logistics software firms. You have an edge that is impossible to replicate from the outside. You know which companies are well run and which are cutting corners because you live in that world every single day. Next, look at your cost of goods sold. What are the major products and services you spend money on? Where do your biggest expenses lie? If you just went through the process of buying a home, you now have a crash course in the mortgage industry, title insurance, and home improvement retail. If you're a car enthusiast, you have a deep understanding of auto manufacturers, parts suppliers, and dealership networks. You are an expert consumer in these categories. You have first-hand knowledge of product quality, customer service, and brand reputation. This is fertile ground for investment ideas. Peter Lynch, another legendary investor, called this investing in what you know. Finally, look at your research and development budget. What are your hobbies and passions? What do you spend your free time reading about, not because you have to, but because you love to? If you're a passionate gamer, you have an intuitive grasp of the video game industry, the publishers, the hardware makers, and the emerging trends like esports. If you're a home cook who loves high-end kitchen gadgets, you have a real-world perspective on companies in the housewares sector. These areas of intrinsic motivation are where you are most likely to do the deep, enjoyable work required to elevate your understanding from that of a consumer to that of an expert investor. By mapping out your personal P&L, your career, your major expenses, and your passions, you create a customized, tangible list of industries where you have a natural, pre-existing analytical advantage. This is the most effective way for a retail investor to start building a powerful, personalized investment strategy. The opposite of this deeply personal, self-aware approach is the guru chaser. This is the individual who, lacking a circle of their own, attempts to rent one from somebody else. They subscribe to an expensive stock-picking newsletter, they religiously follow a financial celebrity on social media, or they buy whatever the expert on a financial news network recommends. They have completely outsourced the most critical part of the investment process, the thinking. Their portfolio is a collection of other people's opinions. The fatal flaw in this strategy is that it provides conviction without understanding. When the market inevitably turns down and their stocks are down 30%, they have no foundation to stand on. They can't recall the initial investment thesis because it was never theirs to begin with. They don't know if the company's fundamentals have changed or if it's just market noise. Fear takes over, and they sell at the absolute worst time, locking in a loss. Furthermore, the guru chaser often fails to recognize the agency problem at play. The guru's incentives are not always aligned with their followers. The guru might be compensated based on trading volume, or they might be talking their book, recommending stocks they already own to drive up the price before they sell. Without your own circle of competence, you have no way to independently verify the quality of their advice. You are a ship without a rudder, at the mercy of the prevailing winds and the questionable navigation of others. Building your own circle, even if it's small, gives you that rudder. It gives you the intellectual independence to evaluate ideas on your own terms and the deep-seated conviction to hold on to your best ideas during periods of market turmoil. True financial freedom is not about having someone tell you what to do. It's about having the knowledge and confidence to make your own decisions. The financial connection of this disciplined approach is rooted in efficiency and opportunity cost. Operating outside your circle is incredibly inefficient. The amount of time, effort, and even money required to get up to speed on a completely new and complex industry is astronomical. Imagine a history professor trying to perform due diligence on a semiconductor company. They would need to learn about photolithography, Moore's law, and the complex geopolitics of the global supply chain. It would take months, if not years, of dedicated study to even begin to have an informed opinion. That time is an opportunity cost. It's time that could have been spent analyzing companies within their existing circle, perhaps a publishing house or an education technology company, where their base of knowledge would allow them to spot an undervalued opportunity much more quickly and with much greater confidence. By staying strictly within your circle, you dramatically lower your research cost for each new investment idea. You are leveraging a lifetime of accumulated knowledge. This efficiency is a massive financial advantage. It allows you to analyze a greater number of potential investments within your zone of genius, thereby increasing the probability that you will find a truly exceptional, mispriced opportunity. It's like being a fisherman. You can either spend your time trying to learn how to fish in every ocean, sea, and river in the world, or you can become the undisputed master of a single small lake that you know better than anyone else. You know where the fish hide in the summer, You know what bait they prefer in the fall. The second fisherman will almost certainly have a better, more consistent catch. The financial market is the same. Your portfolio's growth is directly tied to the efficiency and quality of your research process. Sticking to your circle ensures that every hour you spend on research is a high-leverage activity, directly contributing to your potential for long-term outperformance. There is no greater test of an investor's discipline than their ability to resist the siren song of a massive, market-wide mania. And there is no greater example of this than Warren Buffett's conduct during the dot-com bubble of the late 1990s. It's difficult to overstate the psychological pressure he was under. The world was changing. The internet was going to revolutionize everything. A new breed of technology companies, many with no profits and no clear business plan, were seeing their stock prices multiply overnight. Cab drivers were trading tech stocks, and everyone was getting rich. Meanwhile, Buffett, with his portfolio of old economy stocks like Coca-Cola and See's Candies, was looking like a relic. The financial media was relentless. A famous cover of Barron's magazine in 1999 featured a picture of him with the headline, "What's Wrong, Warren?" He was publicly ridiculed. Pundits and newly minted tech billionaires openly declared that his style of value investing was dead. They said he was a dinosaur who simply didn't get it. At shareholder meetings and in interviews, Buffett was peppered with questions about why he was sitting out the biggest boom in a generation. His response was a masterclass in intellectual honesty and discipline. He calmly explained that it wasn't that he was negative on the internet's potential. He was sure it would change the world. The problem was that this fact didn't make it a good investment for him. Out of the hundreds of new automotive companies at the start of the 20th century, he would say, only a handful survived. He had no special insight, no analytical edge, that would allow him to pick the winners from the losers in the new internet gold rush. He couldn't look at a company like Yahoo or GeoCities and project with any degree of certainty what its earnings and cash flows would be in 10 years. Therefore, they were outside his circle of competence, so he put them in his too-hard pile and did nothing. He was willing to look foolish, to underperform, to be called a dinosaur, rather than betray his most fundamental principle. And then, in March of 2000, the bubble burst. The Nasdaq, a tech-heavy index, proceeded to lose nearly 80% of its value over the next 2 years. Companies that had been worth billions went bankrupt. The new paradigm was revealed to be the same old story of speculative excess. Buffett, who had preserved his capital, was left standing with a mountain of cash, ready to buy the world's best businesses at bargain prices from the very people who had been laughing at him just months before. It was the ultimate vindication of his philosophy. The psychological force that Buffett so masterfully resisted is one of the most powerful and destructive biases in finance, social proof, more commonly known as herd mentality. Humans are social creatures. We are hardwired to look to others for cues on how to behave, especially in situations of uncertainty. When we see everyone around us doing something, and especially when we see them getting rich doing it, an almost irresistible psychological pressure builds to join the crowd. This is the engine of fear of missing out, or FOMO. It overrides our rational brain. Our logical analysis might tell us that a stock is overvalued or that we don't understand the business, but the primitive, emotional part of our brain screams, "Everyone else is making money. If you don't buy now, you'll be left behind forever." This feeling is a form of social pain, the pain of being the outsider, the one who missed the party. The circle of competence is your psychological fortress against the herd. It is a pre-committed, logic-based rule that cannot be overridden by social pressure. When the FOMO begins to creep in, you can consult your circle. Is this hot new AI stock in an industry you've defined as your area of expertise? No. Does it fall into your too hard pile? Yes. The decision is already made. The rule is the rule. It gives you a reason, a powerful justification, to stand apart from the stampeding herd. It turns the social pain of being an outsider into a point of intellectual pride. You are not missing out. You are exercising discipline. You are not a dinosaur. You are a professional playing your own game. It provides the emotional anchor necessary to ignore the noise and stick to your long-term investment strategy, especially when it is most difficult and therefore most important to do so. To weaponize this principle in your own decision-making, you can use a powerful mental model popularized by Buffett's partner, Charlie Munger, the inversion test. Instead of asking how you can succeed in a particular investment, you invert the question and ask, how could this investment fail? What are all the ways this could go to zero? This simple flip in perspective is incredibly effective at revealing risks that are often overlooked in the excitement of a new idea. Let's apply it to a hot, speculative biotech stock that your friend told you about. Instead of asking, how high could this go if the new drug is approved? You invert. How can I lose all my money here? First, the Phase 3 clinical trial could fail to meet its endpoint. Do I have the medical and statistical knowledge to evaluate the probability of that trial's success? No. Second, even if the trial succeeds, a competing company's drug could prove to be more effective or have fewer side effects, destroying our drug's market potential. Do I have a comprehensive view of all competing drugs currently in development? No. Third, even if the drug is approved and is the best in class, the company could fail to get favorable reimbursement terms from insurance companies, severely limiting its revenue. Do I understand the complex world of pharmaceutical pricing and insurance negotiations? No. Fourth, the company is burning through cash and will need to raise more money soon. If the stock market is down when they need to raise capital, they might be forced to issue shares at a very low price, massively diluting my ownership stake. Can I predict the state of the capital markets in 6 months? No. By performing this inversion test, you have quickly and brutally revealed the truth. You are not equipped to play this game. You don't have the competence to evaluate the primary risks associated with this investment. The inversion test forces you to confront your own ignorance. If you cannot clearly identify and analyze the primary ways an investment can fail, you have absolutely no business making that investment. It is an instant clarifier, a tool that cuts through the hype and forces you to focus on what matters most, the preservation of your capital. The path of the 99% is often paved by a related cognitive error, the complexity bias. This is the tendency to believe that complex solutions are better than simple ones. In investing, this manifests as a dangerous attraction to strategies and products that are difficult to understand. The amateur investor might feel that a simple portfolio of index funds or a handful of blue-chip stocks is too, well, simple. They feel unsophisticated. So they get drawn into complex options trading strategies, leveraged ETFs, or private equity funds with convoluted fee structures. They believe that if they don't understand it, it must be smart. They conflate jargon with intelligence. Wall Street loves this investor. The financial industry has a long history of creating complex, opaque products that carry high fees and hide significant risks. Complexity is often a cloak for high costs and poor returns. Warren Buffett, on the other hand, is a devotee of simplicity. His core holdings are in businesses that a child could understand: soft drinks, insurance, railroads, chocolate. His genius is not in understanding complexity, but in recognizing and profiting from simplicity. He knows that a simple business model is easier to analyze, its future is more predictable, and it is less likely to harbor nasty surprises. The circle of competence is, at its heart, a commitment to simplicity. It's a declaration that you will only invest in things that you can explain easily and understand deeply. It protects you from the allure of complexity, which so often is just a way for other people to make money off of your confusion. The direct financial consequence of chasing complexity and hype outside your circle is the volatility tax. This is a subtle but devastating mathematical penalty that erodes long-term returns. Let's say investor A invests in a high-flying speculative tech stock outside their competence. In year 1, it goes up 50%. In year 2, during a market downturn, it crashes by 40%. Investor A started with $100. After year 1, they have $150. After year 2, they lose 40% of that $150, which is $60. They are left with $90. Despite an average annual return that seems positive, they have actually lost 10% of their capital. Now consider investor B, who stays within their circle and buys a stable, predictable consumer goods company. In year 1, it goes up a boring 10%. In year 2, it goes up another 10%. Investor B started with $100. After year 1, they have $110. After year 2, they gain 10% of that $110, which is $11. They are left with $121. This is the volatility tax in action. The wild swings of the speculative stock, the large downward moves, mathematically damage the compounding process. Even if the speculative stock has moments of brilliance, the severe downturns create a drag on the portfolio's long-term growth rate. By staying within your circle of competence, you are naturally drawn to more predictable, less volatile businesses. You are not just managing risk in a philosophical sense, you are actively minimizing the mathematical penalty of volatility. Over an investing lifetime of 20, 30, or 40 years, the difference in outcomes between a smooth, steady compounding portfolio and a volatile, erratic one is not just a few percentage points. It is often the difference between a comfortable retirement and a constant state of financial anxiety. This is a crucial element of building lasting wealth and achieving genuine financial freedom. The culmination of this entire philosophy, the final act where discipline transforms into immense wealth, is best captured by one of the most famous investments in history, Warren Buffett's purchase of the Coca-Cola Company in 1988. This was not a bet on a speculative new technology. It was not a complex financial engineering play. It was the quintessential circle of competence investment. Buffett had been a consumer of Coke since he was a child. He understood the product intimately. But his understanding went far beyond just being a customer. He saw what the market, in its short-sighted panic following the Black Monday crash of 1987, was temporarily missing. He saw a business with a nearly unassailable competitive advantage. He understood the power of the brand. Coca-Cola wasn't just a beverage. It was a symbol of America, of happiness, of refreshment. It occupied a piece of real estate in the minds of billions of people around the globe. This mental monopoly allowed Coca-Cola to charge a premium for what was essentially sugar water. He also understood the business model. It was brilliantly simple. The company produced a syrup, which it sold to a global network of bottlers who did all the heavy lifting, the manufacturing, the bottling, the distribution. This made it an incredibly capital-light business that gushed free cash flow. Finally, he saw the global growth story. While Coke was dominant in the US, there were billions of people in developing countries who were only just beginning to be able to afford the product. He could see a clear path for decades of future growth. All these elements were squarely within his circle. It was a business he could analyze, value, and understand with supreme confidence. So in 1988, he invested over $1 billion, representing a massive portion of Berkshire's portfolio at the time, into Coca-Cola stock. That single, high-conviction bet, made possible by a lifetime of discipline, has since generated tens of billions of dollars in dividends and capital gains for his shareholders. It was the perfect fusion of patience, opportunity, and deep, unshakable competence. This ability to act with such conviction is a direct result of overcoming a psychological burden known as the paradox of choice. The psychologist Barry Schwartz famously demonstrated that while we think we want more options, having too many choices actually leads to anxiety, indecision, and ultimately, less satisfaction with the choice we finally make. The modern stock market is a perfect example of this paradox. There are tens of thousands of publicly traded companies, thousands of ETFs, mutual funds, and other financial products. For the average investor, this ocean of options is paralyzing. They don't know where to start. They end up dabbling, buying a little bit of this and a little bit of that, never achieving a deep understanding of anything they own. The circle of competence is the ultimate solution to the paradox of choice. It is a radical act of simplification. By consciously and deliberately deciding to ignore 99% of the investment universe, you free your mind. You are no longer responsible for having an opinion on every new IPO or every hot sector. Your cognitive load is dramatically reduced. You are left with a small, manageable list of companies and industries that you have predetermined you are qualified to analyze. This clarity is a superpower. It allows you to move from a state of anxious paralysis to one of focused, confident action. When an opportunity appears within that small, well-understood universe, you can pounce on it with the conviction that Buffett brought to his Coke investment, because you are not making a random choice from 1,000 options. You are acting on deep knowledge within your own curated field of expertise. To cultivate this level of focus and conviction, Buffett proposes a powerful mental model, the 20-slot punch card. He asks you to imagine that at birth, you are handed a punch card with only 20 slots on it. Each time you make an investment, you have to punch one of those slots. Once all 20 are punched, you can't make any more investments for the rest of your life. This thought experiment fundamentally changes your behavior. Suddenly, the idea of making a casual, speculative bet on a stock you barely understand becomes terrifying. You wouldn't waste one of your precious 20 slots on a whim. Each decision becomes monumental. You would do exhaustive research. You would wait patiently for an opportunity that was not just good, but extraordinary. You would only swing at the fat pitches, the rare, no-brainer opportunities that land squarely in the middle of your circle of competence. Adopting this mindset forces you to raise your standards dramatically. It shifts your goal from finding something to buy today to patiently waiting for a truly world-class opportunity. A retail investor can apply this by simply tracking their decisions. Keep a journal of your punches. Before you buy a stock, ask yourself, is this idea so good? Is my conviction so high that I am willing to use one of only 20 lifetime slots on it? This mental model enforces extreme selectivity. It promotes the patience and discipline required for a successful long-term investing strategy. It ensures that your portfolio becomes a curated museum of your absolute best ideas, not a crowded junkyard of mediocre ones. This is how you move from being a market participant to a master capital allocator. The antithesis of this concentrated, high-conviction approach is what Peter Lynch termed diversification. This is the common mistake of investors who believe that the more stocks they own, the safer they are. They end up with a portfolio of 100, 150, or even 200 different stocks, ETFs, and mutual funds. They own a piece of everything. They have diversified away their ignorance, but in the process, they have also completely diversified away any chance of meaningful outperformance. Their sprawling portfolio is so broad that its performance will inevitably mirror that of the overall market, minus the fees and transaction costs they've incurred along the way. They have essentially created a closet index fund that is more expensive and infinitely more complicated to manage. They own so many companies that it's impossible for them to have any real knowledge about most of them. They have no edge, no alpha, just a random collection of bets that reflects the market as a whole. The 20-slot punch card is the antidote to diversification. It forces you to recognize that true risk management comes not from owning a little bit of everything, but from deeply understanding a few great things. Ultimately, the direct financial transformation promised by this entire philosophy comes from the power of concentrated capital. The circle of competence is not just a defensive tool for avoiding mistakes, it is an offensive weapon for building massive wealth. When you have done the work, when you have defined your circle, when you have waited patiently with your 20-slot punch card, and a truly incredible opportunity emerges within your zone of genius, a great business run by honest managers, available at a ridiculously cheap price, the circle of competence gives you the courage and conviction to bet big. Instead of timidly putting 1% of your portfolio into your best idea, you have the confidence to invest 10%, 15%, or even more. This is the sniper rifle approach versus the shotgun approach. The diversifier with 100 stocks hopes one of them will do well. The focused investor with 5 to 8 stocks expects them to do well, because each one has passed an incredibly rigorous set of tests. The mathematical impact of this is staggering. A 15% position in a stock that doubles adds 15 percentage points to your portfolio's total return. A 1% position in a stock that doubles adds a measly 1%. Fortunes are not built by spreading your capital thinly across hundreds of mediocre ideas. They are built by identifying a small number of exceptional opportunities and concentrating your capital in them. The circle of competence is the foundation that makes this intelligent concentration possible. It provides the intellectual and emotional framework required to make large, decisive bets and to hold them for the long term, allowing the miracle of compounding to work its transformative magic on your net worth. This is the final financial alchemy, turning knowledge not just into profit but into life-changing wealth. So you have journeyed through the core of one of the most powerful mental models in finance. You have seen how the simple, humble act of defining what you know and, more importantly, what you don't know, is the ultimate tool for risk management and the foundation for building lasting wealth. You now possess the blueprint to build your own circle of competence, a filter that can protect you from the market's noise, from your own psychological biases, and from the catastrophic errors that derail the financial lives of 99% of investors. You've acquired a weapon of discipline and a shield of intellectual honesty. But mastering this principle, as crucial as it is only the first part of the equation. You have built the wall of your fortress. You have defined the territory where you are qualified to hunt for opportunities. This is a monumental step. It answers the question of where to look. However, a map is useless if you don't know how to read it. Now, an even more critical question remains. Once you find a company squarely within your circle, how do you determine what it's truly worth? Knowing your circle of competence prevents you from making stupid mistakes, but knowing how to calculate intrinsic value is what allows you to make brilliant investments. It's the engine that turns your defined circle into a machine for generating superior returns. The video that is now on your screen is the missing link. It is the next piece of the map. It bridges the gap between identifying a potential opportunity and executing a profitable investment. It is the practical toolkit for valuation, the process that connects the qualitative understanding of a business to the quantitative decision of what price to pay. What you have just learned is the art of saying no. What comes next is the science of saying yes. The journey to becoming a truly intelligent investor, a master capital allocator, is a process of assembling a network of interconnected mental models. You have just forged a critical link in that chain. The choice now is simple. Do you stop here, with a powerful but incomplete weapon, or do you continue your ascent? The decision to click is not about watching another video. It is a commitment to completing your mental arsenal, to becoming not just a participant in the market, but a power within it. Continue the journey.